Welcome to our comprehensive guide on fundamental financial terms that everyone should know. In this video, we'll explore the following terms: assets, amortization, arbitrage, annuities, and accounts receivable. Understanding these terms is crucial for managing your personal finances, making informed investment decisions, and enhancing your financial literacy. So, let's dive in.
First, let's talk about assets. In finance, an asset is anything of value owned by an individual or a company. Assets are classified into various categories, including tangible and intangible assets. Tangible assets are physical items like real estate, vehicles, equipment, and inventory. These assets are often used in the operation of a business or held for investment purposes. Intangible assets, on the other hand, are non-physical items that have value. These include intellectual property, patents, trademarks, and goodwill. Goodwill represents the excess value of a company's assets over its liabilities and is often associated with the company's reputation or customer relationships. Assets can also be categorized based on their liquidity, which refers to how quickly they can be converted into cash. Cash and cash equivalents, such as savings accounts and treasury bills, are considered highly liquid assets. Real estate and machinery, while valuable, are less liquid as they cannot be easily sold without a significant loss of value. Understanding the different types of assets and their characteristics is essential for financial planning and investment. For instance, knowing the liquidity of your assets helps you plan for emergencies or unexpected expenses. Additionally, investing in a diverse range of assets can help mitigate risks and improve the potential for returns. For example, real estate properties, whether residential or commercial, are often considered a significant part of an individual's or a company's asset portfolio. Investments like stocks, bonds, mutual funds, and other securities represent investments that can grow in value over time. Innovations, brands, and proprietary technology are examples of intellectual property, which can be valuable assets for businesses, contributing to their competitive advantage.
Now, let's explore the concept of amortization. Amortization is the process of gradually paying off a debt over time through regular payments. This term is most commonly used in the context of loans, such as mortgages, car loans, and personal loans. When you take out a loan, you agree to repay the borrowed amount, the principal, along with interest over a specified period. Amortization schedules are used to outline how each payment is divided between the principal and the interest. In the early stages of the loan, a larger portion of each payment goes toward interest, with the remaining amount applied to the principal. As the loan matures, more of each payment is applied to reducing the principal. There are two main types of amortization: full amortization and partial amortization. Full amortization means that the loan will be completely paid off by the end of the term. In contrast, partial amortization involves paying only a portion of the principal during the loan term, leaving a remaining balance known as a balloon payment due at the end. Understanding amortization is crucial for managing debt and making informed financial decisions. For instance, when comparing loan offers, it's essential to consider not only the interest rate, but also the amortization schedule, as it affects the total cost of the loan over time. For example, home buyers often use amortization schedules to understand how their monthly payments will change over time, and how much of each payment is applied to the principal versus interest. Similarly, car loans are typically amortized, with borrowers making regular payments until the loan is fully repaid. Companies use amortization schedules to plan for debt repayment and manage cash flow.
Up next is arbitrage. What is arbitrage? Arbitrage is a financial strategy that involves taking advantage of price differences in different markets. It is a technique used by traders and investors to earn a profit with minimal risk. The concept of arbitrage is based on the principle that identical or similar assets should have the same price in different markets. However, due to market inefficiencies, temporary price discrepancies can occur. There are various forms of arbitrage, including pure arbitrage, risk arbitrage, and statistical arbitrage. Pure arbitrage involves buying an asset in one market where it is undervalued and simultaneously selling it in another market where it is overvalued. This type of arbitrage is considered risk-free because the transactions are conducted simultaneously. Risk arbitrage, also known as merger arbitrage, involves trading stocks of companies involved in mergers or acquisitions. Investors speculate on the likelihood of the merger being completed and the terms of the deal, taking positions in the stocks of the target and acquiring companies. Statistical arbitrage uses mathematical models and algorithms to identify and exploit statistical patterns in market data. This form of arbitrage often involves high-frequency trading and requires sophisticated technology and infrastructure. Arbitrage plays a vital role in maintaining market efficiency by correcting price discrepancies. However, it requires expertise, quick decision-making, and access to multiple markets. For retail investors, opportunities for arbitrage may be limited due to transaction costs and market access. For instance, currency arbitrage involves traders taking advantage of differences in exchange rates between different currency pairs in the forex market. Commodity arbitrage involves buying commodities in one market where prices are lower and selling them in another market where prices are higher. Index arbitrage exploits price differences between index futures and the actual stocks in the index.
Next, let's talk about annuities. Annuities are financial products designed to provide a steady income stream, typically for retirees. An annuity is a contract between an individual and an insurance company, where the individual makes a lump sum payment or a series of payments in exchange for periodic payments that begin either immediately or at a future date. There are different types of annuities, each with unique features and benefits. Fixed annuities provide regular, guaranteed payments over a specified period or for the annuitant's lifetime. The payments are fixed and do not fluctuate based on market conditions. Variable annuities, on the other hand, offer payments that vary based on the performance of underlying investment options chosen by the annuitant. These options often include stocks, bonds, and mutual funds. Indexed annuities offer returns based on the performance of a specific market index, such as the S&P 500. They provide a minimum guaranteed return with the potential for higher returns based on the index's performance. Annuities can be further categorized into immediate and deferred annuities. Immediate annuities begin payments almost immediately after the initial investment, while deferred annuities start payments at a future date, allowing the invested amount to grow over time. Annuities can be an effective tool for retirement planning, offering a reliable income stream that can supplement other sources of retirement income, such as Social Security or pensions. However, it's essential to consider factors such as fees, surrender charges, and the financial stability of the issuing insurance company before purchasing an annuity. For example, many retirees use annuities to ensure a steady income stream during their retirement years, helping to cover living expenses and healthcare costs. Annuities can also be structured to provide income to beneficiaries after the annuitant's death, making them a useful tool for legacy planning.
In our last section, we will talk about understanding accounts receivable. Accounts receivable, or AR, refers to the outstanding invoices or money owed to a company by its customers for goods or services provided but not yet paid for. It is considered an asset on the company's balance sheet, as it represents a legal obligation for the customer to pay for the products or services rendered. Managing accounts receivable is crucial for maintaining a healthy cash flow and ensuring the company's financial stability. Effective AR management involves several key practices, including establishing clear credit policies to determine which customers are eligible for credit and under what terms. This includes setting credit limits and payment terms, such as net 30 or net 60 days. Timely and accurate invoicing is essential for prompt payment, ensuring that invoices include all necessary information such as the due date, payment methods, and any applicable discounts for early payment. Companies must also follow up on overdue accounts to collect outstanding payments, which may involve sending reminders, negotiating payment plans, or in some cases, taking legal action. Accounts receivable can also be used as a financial management tool. For example, businesses may sell their AR to a third party, factoring, to receive immediate cash flow. Factoring involves selling the receivables at a discount, providing the business with quick access to cash while transferring the risk of collection to the factoring company. Understanding and effectively managing accounts receivable is vital for businesses of all sizes, as it directly impacts cash flow, profitability, and overall financial health. For example, a retail store selling goods on credit records the sale as accounts receivable until the customer pays the invoice. Similarly, a company providing services such as consulting or maintenance may have AR for services rendered but not yet paid for. We hope this in-depth overview of these essential financial terms has provided valuable insights and enhanced your understanding of personal finance and business management. Remember, financial literacy is a journey, and the more you learn, the better equipped you'll be to make informed financial decisions. Thank you for watching.